Hello Internet, this is Marko Yamashita, YouTube's only VTuber, wolf of the Nikkei and Wall Street. Today we're talking Cover Corporation stock price and laying out a case as to why Hololive's parent company has diminished in profit and market value throughout 2025. And at the very end, if you've ever thought about investing in Cover Corporation over the next 6 to 9 months, you may have a window of opportunity to do so. Now, contrary to what other people say, Cover has been in a tailspin for 2025, dropping around 16% year to date, and an astounding 35% from their 2025 high. With their 2026 plans calling for a muted first half earnings, forward-thinking investors are rightfully concerned that Cover is sacrificing investor sentiment for diminishing returns. So let's take a look at this. Cover's current forecast calls for a lackluster first half of fiscal year 2026 while promising a strong second half. Historically speaking, Cover's tended to overpromise and underperform in the second half of their forecast. While the company is not in immediate financial danger as they have ample cash and cash equivalents to pay their debts and pay their bills, they will be walking a precarious line that could eat away at their bottom line over the long run. Now don't click away just yet. I can already hear some of you saying out there, but Marko, they made 43 billion yen last year. What are you talking about? Well, you gotta remember that 88% of that number goes to paying their operating expenses, from salaries to equipment to the rent to utility, taxes, and so on. Cover only makes 12% after expenses, and this year, net earnings will be reduced to 7.3% over the first 6 quarters, excluding any unexpected costs with the major projects like Holo Records, Hollow Earth, or the continued development of shows using UE Live. And that's also assuming that these projects begin earning a profit to offset the costs in development after the first 6 months. Cover's problem stems further from their quarterly forecast, where their earnings per share and their revenue numbers don't align with one another to ensure they're meeting their obligations to the shareholders. Now, Cover is sitting in a unique position. Despite earnings showing an alarming decrease in profitability being generated when compared to their expenses, Cover has been able to keep their valuation relatively intact. Cover's intrinsic value sits at $39.19 a share, a staggering 44% undervaluation and the lowest it's been in 20 months. However, the cracks are beginning to show once you break down the fundamental data. When you begin looking at the quarterly comparison, you see cracks form with the company's cash flow. This metric is often used as an alternative or comparison, since revenue numbers can be manipulated through various accounting practices. A big bonus for investors are Cover's ROIC and ROE. While not reaching the levels of their competitor, they are positioned well enough to generate positive returns if the company strikes a positive balance between spending and consistent revenue generation. And while our experiment with AI painted a different picture, investment firms are forecasting an average of 32.76 yen a share over the next 12 months. Cover's flip to a profitable second half will likely hinge on heavy monetization and use of Hollow Earth, combined with medium to large scale shows, along with a 6-month blitz of merchandise starting from October through March. So here's the final point. Whether or not they hit their targets in these first 2 quarters, Cover had been expecting a lower than average result. If they surpass them, great for current investors. If they don't, and the price point sinks even further, that's also great for investors. Why? Because most people believe Cover is still worth more than what they are right now. A missed forecast and price drop is an opening to buy a good company at a discounted price. The market is about being patient, for positive results rather than quick money. Sell by breaking even or at a profit. Hold until that happens. Dips happen. Most companies do recover. It takes patience. If cover is truly still in their growth and development phase, time and patience are ultimately required to see the results. So breathe and don't panic. Yet stay vigilant. If you don't like what you're seeing, know your margin of safety, know when to say when, and know when to walk away. No one will blame you. No one will blame you for walking away. Opportunities come and go, and once they're gone, they rarely return again. So invest smart and plan ahead, my friends. Until next time, this is Marko Yamashita, signing off. Peace.